Do not wait for rates to go down before you enter the market, whether you're buying or selling.
Hey everybody, welcome to Change and the Market, your mindful guide to the ever-changing real estate world. My name is Peyton Beck, sitting here at Masiello HQ, for real this time. I'm joined today by Chris Masiello, CEO, author, and Ouija board collector. Chris, how are you today?
Good, Peyton. Glad to see you're in Portland, Maine.
Yeah, it's beautiful here.
Yeah, Portland's an amazing city. So we missed you last week. Kevin did a yeoman's job filling in for you.
Yeah. Well, we'll just have to talk about that later, I guess.
Yeah, we're waiting for your comeback.
Yeah,
so we know it's coming.
So Chris, what are we talking about today?
A little bit of a summary, kind of what's gone on. We're still like sifting through all sorts of market data and all that, and I really put this in the category of continuation of sense making. Same song, maybe a little different melody. Now I'll start with the Federal Reserve meets again today. They meet every 2 months. They'll probably hike interest rates up another quarter point. Consensus is that's probably it. Inflation is down around 3%. So what does that all mean? That means that, interest rates are probably going to kind of stay the way they are, the mortgage rates. And what's interesting about it, if you look at it historically, over the last, say 40 years, the average interest rate's about 7%. So interest rates right now are the same that they were in the early 70s. They've moved around a little bit, of course, over the years, but generally on average, this is the norm. Actually, the norm is 7.75, and we're still underneath that. And, inflation is under control. We're down around that 3% range. And interestingly, though, is that consumer confidence is very high right now. And it's because people are employed. And there's wage growth, right, which is in part of what's led to inflation. And so what we're finding now is that people are they're re-entering the market, even though there's a little bit of a rate shock for the last, 12 months or so. They're re-entering the market because they're confident about their jobs. Housing prices, this is the fourth month in a row that they've gone up. So you can see this settling into the new norm. Like, this is the new normal. We can make this work. At this point, rates are probably only going to go down, right? The Fed funds rate, which is the rate that gets charged between the banks, goes up a little bit. It might move mortgage rates up slightly, but at this point, pretty much we'll be on a downward slope is the projection.
Well, that's always exciting news. I actually heard I don't remember who I was talking to, but they were discussing the projections for next year, kind of from the various boards and organizations who decide to do those projections. And some people were talking about the expectation of it dropping quite a bit, maybe even to like 5%. Do you feel like you think so? That could be a legitimate?
It's possible. It's possible. I'm not an advocate for how the Federal Reserve is handling the economy. So that's probably a whole nother episode we could shoot. But it's a little bit of witchcraft. This is like chainsaw carpentry. This isn't microsurgery, right? You're trying to manage a huge economy, and it doesn't move on a dime. So we won't know if by raising interest rates 11 times in the last 18 months, we're not going to know if that was too much. We're not going to know for a little bit. But there's a slight risk of a recession, but no one just seems too concerned about it. And I would kind of say the same thing. I'm not overly concerned about it. There's some signs that we could have one. If we did, it would be pretty mild. And actually, we could be halfway through one right now and not know it. So generally, I'm pretty bullish. And I think the other thing, going back to the market and a strategy, I circulated an article to the whole company about don't wait for rates to go down, buy now. And that is, it was probably the best article I've seen, and certainly you put it in words that were better than I could have articulated. And that is a firm mantra now. That went from being kind of speculative advice a few months ago to, yeah, we think it's a good idea, to, no, that's the strategy. Today, that's the strategy. Do not wait for rates to go down before you enter the market, whether you're buying or selling. Get in now. You're going to get the advantage of pricing. That prices are a little softer now. You're going to be leaning into an upward pricing market, and be leaning into interest rates. Eventually sliding down, but don't wait. And I think that's a really good strategy. Time your move around your life, not around some external event that you don't have any control over. And so this was a really good article that I circulated, and that's gone from being, speculative advice to, yeah, no, we think that's the trend, to, no, do this. And I think it's really good advice.
So what is that? So, okay, we know how the show's structured, right? So what does that mean for us, like when we're looking at, because I just mentioned, right, like the idea that maybe next year there's a possibility of it dropping to possibly 5. We hear people always talk about, oh, it could be this. Are you going to wait for that? Are you going to do whatever? How do you combat that? How do you look at your strategy in your?
Well, I think there's a couple facts that I think matter to, and then I think they lean into the don't wait piece. Okay. One is that, well, this is the average of what interest rates have been anyways. So that's the first thing. We just got used to cheap money because you had an economic collapse in '08, right? And then you had a pandemic. So we just got used to having cheap money. That's not the norm. The other piece too is that over the last 100 years, okay, since 1926, so I'll spot myself the other 3 years, right? Is that over the last 100 years, real estate and the stock market are the two most productive wealth generating tools for the American family. And there's no mistake that over 2/3 of all American families own their own home. And it's no mistake that in some way, shape, or form, many people, I'm not going to say most, many people have got either, retirement funds or, money markets or, some instrument that is tied into the stock market. And so I think what we can leave from a life lesson to this is that you have to have kind of like a long-term vision and think about what that long-term vision is. So like buying your house today, the average family is staying in their house between 9 and 11 years now. That's pretty long-term for most of us. And so be thinking about, these are long-term decisions, and you take a long view of things, and don't get too caught up in the short-term drama of, oh my God, rates have gone up. Well, yeah, rates have gone up. But in the last 40 or 50 years, this is the average. In the last 100 years, real estate's the second best family investment you can make. Don't worry about it. Live your life. And if you're not, moving around a lot and you're not making a lot of short-term decisions, you can make long-term decisions that actually kind of give you, the security that you want. And I think right now, the advice about don't wait for rates to go down, if you need to make a move, don't let the externalities get in the way, make your move. I think it's a very potent life lesson. We're going to have a role reversal here. I'm going to do the close. So if you like this, please share this across all your social media. And we look forward to being with you next week.
Great.
And
thank you.
we're glad, we're glad to have Peyton broadcasting from Portland, Maine.
And until next week, we hope that you guys have that was terrible. That was just disgusting. What was that?